Welcome back, everyone. This is Personal Finance for Us. We're going to sort of take a little bit of a break in the baby steps and get into some things that you're going to be doing while you're doing baby steps 4, 5, and 6. Now, it kind of seems like the perfect time to take a break to talk about it, and that is financial defense, aka insurance. Insurance a lot of times gets treated as if it's an investment, and that's not really the role of insurance if you think about it. Insurance is like in case stuff happens, right? So you get car insurance in case you get into an accident. Hopefully you never do and you never need it. You get life insurance so your family can be able to sustain missing your income and aren't devastated financially in addition to the unexpected loss of your life. So hopefully your beneficiaries never ever need a life insurance policy, but things happen. That's the world we live in. So that's why these things are in place, and they're very, very important. So while we're building wealth, it's important that we cover what we're building, and insurance helps us to do that. So the main insurances that we're going to be talking about for our purposes are going to be life insurance, car insurance, and disability insurance. So without further ado, let's go to the PowerPoint. All right, everyone, welcome back to the PowerPoint. We're going to be talking about a subject that need not be controversial, but it ends up being controversial, and that is life insurance, term versus whole. We're going to get into the nuts and bolts of the differences and why you might want to choose one over the other. So let's get into it. So first of all, what is life insurance? Life insurance is a type of insurance which is designed to cover your income in the event of an early, unexpected death. There's generally two types, term and whole life. For most working people, the general recommendation is buying coverage that is 10 times your income. So for example, if you make $50,000 a year, you should get about $500,000 or $500,000 worth of insurance. So term versus whole, what's the difference? So term insurance is insurance that covers you for a specified period of time or term. The coverages are generally anywhere between 10 and 25. You can even get a 30-year term. So the idea is behind term insurance is ultimately you know that hopefully you're going to retire one day, and you're planning for that. You're planning for life after work. Your kids are going to be grown, all that good stuff. Eventually you'll just be hanging out with your grandkids, great-grandkids if you're really fortunate. Basically, the idea is you're saving money now while you're young to be able to cover yourself in the future. Therefore, you only need to worry about your income coverage for a specified term. All right, so how can I say that a little bit more simply? So if you are 30 and you're married and you have 2 kids, you have people depending on your income, right? If, God forbid, something happens to you on your way back home from work and you don't make it home, what happens to your spouse and your kids? That is why life insurance exists. It's to cover you while we're assuming you're still in the bulk of your working years. It's to cover your family in the event that something horrible happens. Whole life insurance. So unlike term, whole life covers you for the duration of your life, assuming you are continuing to pay the premiums. It's often marketed as an investment product rather than as a defensive product. And it also tends to be a lot more complicated than that of term. It has a lot of pieces and subtypes. We'll touch on some of that, but for the purposes of this video, we're really going to get into term versus whole life in general. So who needs life insurance? Life insurance is generally, as I said, for those that you leave behind. So if you are 22, you're not married, you have no kids, and you just graduated college yesterday, do you need life insurance? Well, no, not really, because no one's depending on your income but you. It would be sad, of course. Your parents would be sad about your early dismissal from this world, but you know, you're not leaving dependents behind. The other side of the coin is if you are filthy, filthy rich, right? So, as we said in the discussion about term insurance, the idea is to get eventually to the point where you are self-insuring. So, if you're Jeff Bezos, he's stanky rich, he can self-insure, okay? If something happens to him, he has enough wealth where his family is going to be just okay. I'm sure everybody's got trust funds and all that good stuff in place. His family is going to be just fine. So, we can argue Jeff doesn't actually need a life insurance policy because he has enough wealth where his family would be okay. So, I went on to, I believe it was statefarm.com, and I found this handy dandy tool that they have on term versus whole life. So, I put in some information. A 35-year-old female residing in the state of North Carolina. She wants to get $645,000 worth of coverage, so we're going to assume she's making about $65,000 a year. So when we look to the left here, we see term life insurance. Term life provides protection, a guaranteed death benefit for a specific period of time or term, like we talked about. There is no living benefit. Your premiums never change from the date that you sign the policy. And of course, the death benefit is going to be that lump sum of the $645,000 benefit that you signed up for. For permanent life, aka whole life, like I said, it has many, many names. There is a living benefit because there's what we call a cash value aspect of it that you pay into every month. The premiums are going to that cash value, and there is a death benefit, meaning you do get something if you die. Doesn't sound too bad on the surface there. But then you kind of scroll down a little bit and you get into the cost, okay? So if we select term, once again, we see that $645,000 coverage. To get that coverage is going to cost us $50.40 a month, or $580 a year. Whole life, though, is just a touch more expensive. Okay, so this provides a level guaranteed death benefit for the lifetime of the insured. Premiums are level and payable till age 100. Over time, the policy builds in tax-deferred cash value, aka you have to pay taxes on it, just not right away. And it is eligible, like I said, it's marketed as an investment product, so it is eligible to earn some dividends, which once again sounds good, but then you look at that cost. $736.17 a month, or $8,461 annually. That is a whopping difference. That is a huge difference. So why is there such a big cost difference? Well, let's keep going. Let's talk about whole life. Term we pretty much talked about already. It's simple, right? Like you get a 20-year term, you get $500,000 worth of coverage. You have an unfortunate event that results in the end of your life during that term, your family gets paid. Whole life, a little more complicated. So there are premium payments that we just saw on that last slide. When you make premium payments, a portion of your payment is invested by your insurer. Don't ask me why we would trust an insurer to invest our money for us instead of being with a financial advisor who does this all day long, but okay. Your insurer usually invests money in a low yield investment option. So as long as you pay your premiums, the value will continue to grow. Well, duh. Same thing if we were putting money in a savings account, we keep putting money in the savings account, duh, it's gonna grow. But anyway, however, if you opt to use the proceeds to pay your premium payments, then your cash value won't grow quickly. AKA, if you use the interest that your money is yielding in that low yield investment option, obviously it won't grow as quickly. Death benefits. The core purpose of life insurance is to provide the policyholder's beneficiary with policy's value after their death. As such, the death benefit element is crucial when you're calculating life insurance cash value. When you first purchase your insurance plan, its face value is usually your death benefit. As you continue to pay your premiums, a percent of the payments goes to your death benefits. This means that your cash value becomes a greater fraction of the death benefit as long as you continue paying the premiums. What does all that mean? Stick with me. We're going to get into it. I did forget to mention that these next few slides are copy pasted directly from some insurance sites, as well as from Policy Genius and some financial sites. Those will all be on the reference slide and back down in the description for your viewing pleasure to go really sink your teeth into this stuff. Number 3, loan balances. As noted before, you have the option of using your cash value as collateral when borrowing loans, but keep in mind in doing so affects your death benefit. This is because your cash value is part of your death benefits, I think that's supposed to say. So, the more loan balances you have, the lower your cash value. When your loan balance meets or exceeds your cash value, your beneficiary will not receive a death benefit payment. For that reason, you should only borrow against your cash value when it makes sense. This includes when you have a high cash value and you want to invest in an opportunity that generates reasonable returns. Now, if you've experienced a conversation with anyone insisting that whole life insurance is a wonderful product, as we discussed in bullet point number 1, they're supposed to be investing the money for you, right? Okay, so moving right along. Cash value charts. Some whole life policies usually come with charts. These charts show you the expected appreciation of your cash value over the years. You'll see a corresponding amount with each number of years you maintain your plan. Different policies accumulate cash value in different ways. Of course, cash value accumulation varies depending on the type of policy you have. Whole life policies provide guaranteed cash value amounts that grow according to a formula the insurance company determines. I told you guys, this is some complicated crap. Universal life policies accumulate cash value based on current interest rates. Variable life policies invest funds in subaccounts which operate like mutual funds. The cash value grows or falls based on how well these subaccounts perform. Important. Don't let cash value that has built up in your policy go to waste. Cash value in your policy at your death benefit goes back to the insurance company, not your heirs. I've seen whole life people try to argue that this is not the case. This is just one site. Let's keep going. Step by step, how cash value grows. Let's say you purchase a whole life policy with a $1 million death benefit when you're 25. You consistently pay your monthly premium, and every month a percentage of that payment goes toward the cash value of your policy. 30 years after you purchase the policy, you're now 55, and your cash value account has grown to $500,000. Because the policy offers a $1 million death benefit and you already have a cash value of $500,000, the insurance costs must cover the remaining $500,000. Meaning you stored up so much cash, they're only covering the difference. You've put in $500,000 already. They're only going to pay out another $500,000 because that first $500,000 is yours. It's your money that you've been putting in. Now, another 10 years later, your policy's cash value has grown to $750,000. As you are 65 years old now, the cost of insuring your life is much higher. However, when you factor in your significant cash value, the policy is really only insuring $250,000. Meanwhile, you're still paying these incredibly high premiums, by the way. The rest of the death benefit policy will come from the cash value. This is generally a simplified example. The numbers will vary significantly, blah, 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 blah. So basically, you've paid into this insurance policy your whole life, and they're only going to give you, if you died at 65 and you have $750,000 in there, they're only covering, only $250,000 is coming out of their pocket, guys. This basically says that a whole life policy is basically one big self-insurance. Think about that for a second. If I was just going to put money into a low yield account, why wouldn't I just do that myself? What do I need for the whole life policy? If I had money in my own savings account, I could take it out and borrow it at any time for when something happens. If I did want to invest it, what is the point? What favor are you doing me with this policy? It sounds like really I'm doing all the work myself and for a lot of money. Okay, so this is from Policy Genius now, that they kind of get into this into an even simpler fashion. So let's read what they have to say. Here's where whole life and permanent life insurance in general can get confusing. You can access the cash value of your policy in a few different ways, but each comes with certain risks. If I was self-insuring and just throwing the money under the mattress or in my savings account, that's pretty much risk-free, right? Moving along, you can withdraw money tax-free from the cash value of your policy. However, if you completely surrender your policy or your policy lapses, any money you've withdrawn over your basis, that is the portion of the cash value that is drawn from your premiums, will be taxed as income. You can take out a low-interest loan. In this case, you're borrowing against your policy. As with other loans, a cash value loan accrues interest until you pay it back. And if you die before you pay your cash value back, the amount you owe, including interest, will be deducted from your death benefit. Once again, it just sounds to me like you're paying your own insurance. You can collect the cash value by surrendering your policy, but keep in mind that most of the growth in your cash value happens when you've held the policy for 2 or 3 decades. If you surrender within the first 10 years, it's unlikely that your cash value will be greater than the total premiums you have paid. Some life insurance companies also charge a surrender fee, so you should check with your carrier before terminating your policy. Note that the cash value of your whole life policy is separate from the death benefit. While your beneficiaries are guaranteed to receive the death benefit when you die, provided you've paid your premiums, the cash value component can only be utilized while you are living. This can be confusing to shoppers who believe that in the event of their death, their beneficiaries will receive both the death benefit and the accrued cash. However, anything that remains of your policy's cash value when you die will be retained by the insurance company. So, with all that background out of the way and a pretty clear, I hope, picture of the confusion that is whole life insurance, basically we're funding our death benefit ourselves as well as the insurance company's fat wallet. Let's do a comparison. So I left up my calculator here on the left because I took the annual amount of term, which was $579.55, aka $580, and I multiplied it by the by the term we selected, which was 20 years. $580 times 20 is $11,600. So I am able to buy a term life policy of over $600,000 for $11,600. How does that even compare to our whole life example? It doesn't. Meanwhile, our whole life policy in the first year is going to cost almost that amount for us to self-insure and to pay them fees. I don't know. I feel like I don't feel I don't get why this is such a controversial topic, but let's move on. Okay, so one thing I forgot to mention on this slide here. So I took the difference between the annual amount of the term and the annual amount of the whole life policy. And if you do the math on that, that is about $7,880 a year. Okay, so I'll bust out our handy dandy investment calculator. Now, let's look at what happens. Okay, if we take the difference between these two policies and go to our trusted financial advisor and say, hey, I want to put this into some ETFs or some good mutual funds. What are we looking at? Once again, if this is your first video with me, if you didn't know, generally the stock market is going to give you a rate of return of about 7 to 8%. Let's say on this occasion, this 20 years, we averaged 8%. If we contributed the difference, that's $7,880 a year, and got 8% on our money, during that 20-year time we held that policy, we would have contributed $157,600, and we would have accrued about $203,000 for a total balance of $360,000. I don't know, guys, this just makes a whole lot more sense to do this to me. So that's often where the argument between these two policy types lies, is that, like, well, if you took the difference and invested it instead of just leaving it to sit for the insurance company to do whatever they want to do with it, you at the end of the day would come out much richer. Makes sense to me. All right, guys, so that is going to wrap up the video. These here are the resources that I used. Again, I'll put the links down in the description below, so you can go ahead and research some of this for yourself, do the math. I hope this video wasn't overly confusing. I hope I grabbed some good resources that kind of shed some light on the confusion that is whole life insurance. In my personal opinion, it's needlessly confusing for a reason. So I hope you guys enjoyed the video. I hope you got something from it. If you couldn't tell, obviously, if you ask me, I'm very much going to advocate for term life insurance. I don't know why on God's green earth you wouldn't surrender $12,000 to get $600,000 if you needed it, as opposed to surrendering almost the entire policy amount yourself. It just, once again, doesn't make sense to me. And for the average working class person, paying for these whole life insurance policies is extremely expensive, which is also why I think it's often marketed to rich people who, but once again, if you're fairly wealthy, you don't need it because you're wealthy. So I hope this makes sense. I hope you guys got something out of this video. I hope you enjoyed it. Next time we're going to get into the next section of financial defense, which is car insurance. Look forward to seeing you guys in the next video. Peace.